Hello, everybody. Welcome to this special edition of the Sharesify podcast. I'm James Crux. I'm joined as ever by my colleague Ian Conway. Hi, Ian.
Morning, James.
And we're joined today by a special guest, Anthony Lynch of JPMorgan Claverhouse Investment Trust. Anthony, welcome to the show.
Morning. Thanks for having me.
Now, you're a very busy man as you also co-manage Mercantile and you run some open-ended equity income funds. So we really appreciate your time. Now, just looking at your website, it says Claverhouse gives investors access to the long-term growth and income potential of the UK market. Now, you're invested in attractively valued quality UK companies with that ability to deliver consistent and growing dividends. To kick things off, what differentiates Claverhouse from others in the UK equity income sector?
Sure. I think there are maybe three things that I point to, and clearly, not pointing at what other people do, but really emphasising what we do. The first thing would be the dividend track record. Clearly, there are a number of AIC dividend heroes out there, but I think the 53 years of consecutive dividend increases is a really strong starting place when people are thinking about dependable income going forwards, and that's something that they can get from Claverhouse. The second differentiator, I'd say, is we have three experienced portfolio managers working on Claverhouse. We've got an average of 16 years investment experience each. So that's a real genuine challenge day to day in terms of being able to, have experienced investors having different opinions on things and really debating those out. And actually having a team managed approach is quite common at JPMorgan. So it reflects really that we do have a disciplined and repeatable investment approach. And then finally, I point to our process. So our team and the broader process that sits behind it gives us full coverage of the whole of the UK equity market. So really good opportunity and breadth there. And we're supported by both analysts and also quant research, which is giving us really cutting edge abilities in things like AI in terms of our ability to apply that to our day-to-day stock research.
Now that's really helpful. Thank you. And I guess which stocks and themes have really driven performance in, say, the last year? What would you tease out there?
Yeah, I think normally I like to talk about the stocks and emphasize the stocks, but I think last year actually it is worth touching on a couple of the themes. So the three best performing sectors in the FTSE All-Share were aerospace and defence, banks, and insurance. And actually within Claverhouse, we overweight all three of those sectors. So that was a really nice tailwind to performance. In terms of what didn't work last year, actually, we do have an overweight to small and medium-sized companies, and they have lagged the overall index. We think there are some good value opportunities there, but that's definitely not what's been driving the more recent performance.
Interesting. I've got a quick question, Anthony. There is a phenomenal track record of 53 years of dividend increases. I'm guessing you have a mix of stocks that are high yielders, some compounders, and then those that I noticed you mentioned in one of your presentations on the website, Telecom Plus, for example, that you own over telecoms, and you say it hasn't got that high yield, but it increases its dividend all the time. And ditto with Cranswick, which was again quite a low yielder, but has a great record of increasing dividends. What is the mix? What do you think is the optimum mix kind of those three?
Yeah, so you're quite right in terms of how you deliver dividend growth over a long period of time. You can't just buy companies that have really high yields today. You do have to think about how that growth is going to compound in those outer years. And so you do need a bit of a balance in the portfolio. Within the high yielding bucket, if we call it that, that's just over half of the portfolio. And within that, we're looking for companies that we think, yes, they are high yields, but we actually still expect that dividend to grow. So that's your starting point, is some high yielders that can still grow their dividends. And then around a third of the portfolio would be in what we consider quality compounders. These companies still have quite attractive dividend yields, pretty much in line with the index, at around 3.5% would be pretty typical. And what we like about these businesses is the growth can actually be quite predictable from these companies. A high quality business that's got a very strong track record for organic growth, but then also they can be quite capital light businesses. So the cash that they do generate, they don't need to reinvest that into the business. It can all come back to us as shareholders. Ideally through dividends, often through share buybacks too, but they could be quite helpful as well. And then finally, around 10 to 15% of the portfolio will be in those much higher growth names. I think this gives us an opportunity to enjoy some companies that deliver very strong capital growth. Cranswick is a company that we'd include here as well. But companies that, yes, they might not be an important part of the dividend we earn today, but go forward 5 years or so, that becomes a much more material yield. I think one that we like to talk about sometimes is 3i. It's actually a position we've cut back quite a lot, but it is one of those stocks that came into the portfolio with quite a low dividend yield, but over the course of 5 years, just the compounding of their earnings meant that the yield on that original investment was into double digit.
Wow.
Yeah, that's really useful. That leads on nicely, I guess you've touched on some of these points, but with inflation kind of in the headlines resurfacing as a risk, what gives you the confidence you can extend that half-century winning run of dividend growth, and also whilst growing the payout ahead of inflation?
Yes, I think you're quite right. It looks like the UK might be facing some more inflationary challenges, particularly if oil prices stay where they are today. Although I would emphasise that I think this is very different to the Russia-Ukraine scenario, where the energy supply shock coincided with a period where we already had quite strong economies, demand pull inflation, supply chain issues, etc. But nonetheless, yes, Claverhouse is looking to grow the dividend ahead of inflation over a run of years. That doesn't mean to say that if we had 10% inflation in 1 year, the dividend has to go up 10% that very year. It can be a little bit smoother than that. And I think that smoothing approach is something that clients quite appreciate. In terms of how we deliver on that, actually, it almost goes back to your last question. I think it's that combination of having some of those higher yielders, but then also companies where they might be actually delivering quite defensive growth, where that growth can just keep coming through. That's the important thing. It's not about focusing on who's going to grow their dividend the most this year. It's about over the next run of years, where are those companies going to come from? And even though we've been through, a very difficult environment with the COVID pandemic, Russia-Ukraine war, the supply chain shocks, more recent events, companies like Cranswick, for example, have still grown their revenues, their earnings, their dividend double digit over all of those time periods. So, just focusing on looking through the noise and thinking about where the growth will come from is what I think can underpin that track record.
Yeah. You mentioned, Anthony, you're overweight in banks and defence stocks, and I was just looking at the top 10 in the latest fact sheet. And yeah, you've got HSBC, NatWest, Rolls-Royce has done well. And of course, you've also got top 10 holdings in BP and Shell. And this year they've been, they've just taken off, obviously, because of the oil price. Do you think there's still, pardon the pun, gas in the tank for those stocks?
So I guess maybe starting with the Shell and BP, which you mentioned. So yes, I do. I think when we think about the portfolio, we're clearly thinking about the individual investment case for each of these investments. Also trying to balance that around building a portfolio that's in aggregate can work across a variety of market conditions. And one of the really nice things that BP and Shell give us is clearly, when energy prices spike, which is never good news for the UK consumer or growth, actually those companies do quite well. So I think it all makes sense to have a decent allocation to these two. I think within the two, Shell would be our preferred name of the two. We had actually been starting to get a little concerned that we might be going into an oversupplied LNG market for the next couple of years. But I think recent events clearly mean that that's really been pushed out. And so I think the long-term benefit to Shell could actually be more material there.
Right, okay. And you invest across the market cap spectrum. Is it right that the exposure to small and mids has risen in recent periods? And if so, what's the reasoning behind that?
Yes, so you're quite right. That has taken place. There are really two reasons behind that. So the first of them is myself and Catan joined the Claverhouse portfolio management team about 18 months ago. And both of us have track records in mid and small cap investing. So as you mentioned at the start, I also co-manage the Mercantile Investment Trust, which clearly invests outside of the FTSE 100. And then Catan is also a co-manager on the UK Small Cap Growth and Income Fund as well. So between us, we've added quite a lot of breadth, I would say, in terms of our knowledge of that broader market. Clearly in the UK, the FTSE 100 does account for around over 80% of the all share, but clearly by number of stocks, it's significantly less than that. And so I think just naturally having more depth of coverage across that market cap spectrum is going to naturally mean that we do find more opportunities in the small and mid cap market. That's one of the reasons, but I think the other one is just actually the opportunity that we're finding in small and mid cap at the moment. So, small and mid cap has underperformed large cap for a few years now. That is a relatively unusual environment for that to be happening. We could talk at length about the reasons behind that, but many of them will be quite obvious to your listeners, I'd imagine. But what I think is interesting at the moment is that valuations in that part of the market do look outstandingly cheap. So, the UK is one of the very few equity markets in the world that doesn't look expensive versus history. And then within the UK, small and mid caps are trading at a discount to large caps for probably the most extended period of time on record. So, I think the fact that we're able to find some very attractive yields in what has traditionally been a higher growing part of the market means that we are just finding more opportunities there at the moment than maybe we would have historically.
Anthony, that's brilliant. I think that's us done for questions. Thank you very, very much for coming on the podcast today.
Thank you so much.
What I should say is, before we wrap up, that Claverhouse full year results are out next Wednesday, if I'm right?
It's definitely imminent because I know we've written everything and it's been sent off for printing. So
okay,
yes,
so
we'll get that in the post.
Okay, so if you've enjoyed the podcast and we've piqued your interest, make sure you keep an eye out for the results next week. And with that, we'll see you soon. Thanks very much.
Thank you.